Continuing with Chapter 2, we're now going to cover Learning Objective 2 or Module 2. And here we're going to look at the rules of debit and credit and normal account balances using a double entry system. We're also going to introduce a new way to record business transactions, and that is to use a ledger account or a T account. A T account is an informal ledger account. Transactions, as we said when we cover the accounting equation, will always have two impacts. There could be more, but a minimum, they must have at least two impacts on the accounting equation. So we know from our prior illustrations that when Smart Touch purchased land, the land account increased, but cash decreased by the same amount. So we know that we increased when we bought the land, we increased the land, but we reduced the cash. And as we said at that time, we changed the composition of the assets, but not the total. We converted a non-productive asset, cash, into a operating or productive asset, land. Notice, of course, that the balance, because of the double entry system, total assets equal to $30,000, total liabilities, 0, stockholders' equity, 30. So it's equal to total liabilities and stockholders' equity. Now, as we defined in our prior module, an account is a detailed accounting record. It's an individual accounting record of increases and decreases of individual or specific asset, liabilities, and equity accounts. It is also going to have a balance. When we look at the accounts, we're going to use a T account, which is an informal ledger account, but it is much more efficient to record transactions than the accounting equation. However, we're going to make a very concerted effort to ensure that we tie back the T accounts to the accounting equation. So every account will have a title and maybe an account number based on the chart of accounts we looked at in the prior module. It'll have a left or a debit side and a right and a credit side. The T account, as I said, is really a visual of a more formal record. Ledger accounts are really part of a computer system today, so that this is a visualization of what is going on in an information system. And the account is, again, the T account is shaped like a T, and that's where it gets its name. It has increases on one side, decreases on the other. Now, notice the terminology, debit and credit. Debit and credit simply means it's the left side of the account. Credit simply means it's the right side of the account. It does not mean increase or decrease. It could mean either. We need to know what accounts we are dealing with and the rules of debit and credit for those accounts. And the most important thing to recall is that it must be balanced. Just like the accounting equation, it must be balanced. So again, the terms debit and credit simply mean left and right respectively. They do not mean increase or decrease. The act of entering something on the left side of an account is said to be debiting that account. Entering something on the right side of the account is said to credit that account. When we have debits that exceed credits, the account is said to have a debit balance. If credits are larger than the debits in a particular account, we say we have a credit balance. But once again, debit and credit absolutely does not mean increase or decrease. It'll depend on the nature of the account. Is it an asset, liability, and revenue account, etc. And you have to know the rules of debit and credit. So to summarize, what are debits and credits? Debits and credits simply mean that a debit is going to be the left side of the ledger account, abbreviated DR, and a credit is the right side of a ledger account, abbreviated CR. Anytime we put a debit in one account, we have to put an equal amount of a credit on the other in order to balance, just like the accounting equation using the double entry bookkeeping system. When an account has more debits than credits, it has a debit balance. And when an account has more credits than debits, it's got a credit balance. Some accounts will be increased by debits, others will be decreased by debits, and we need to understand the rules of debit and credit first. But making this point clear is, let's assume we've got two accounts. This will be account A, and this will be account B. Let's say that for account A, you entered $1,000 worth of debits and you credited that account for $6. The balance in this case is a debit balance of $400. Conversely, if you have another account where you entered credits of $900 and debits of $700, as a balance of $200, and that is a credit balance. So entering debits and credits, more debits than credits means it's a debit balance. If credits are larger, we have a credit balance. Now, the key to this module is, in order for you to determine whether or not debits and credits increase or decrease an account, we have to know the rules of debit and credit. So when entering a transaction, the transaction must have debits equal to credit. So just like you needed to have assets equal to liabilities plus stockholders' equity, now we have to be sure that debits are equal to credits. And we'll find out that because the double entry system is tied to the accounting equation, it will in fact do both. When debits are equal to credits, the accounting equation will be in balance. This following diagram clearly exhibits the fact that debits and credits are tied to the equation. So what I'm doing, and I'll give you an expanded accounting equation in a moment, but in general, you'll notice that assets equal liabilities plus stockholders' equity, debits have to equal credit. So for example, let's go back to the case where we started our business, where the company issues $30,000 worth of equity. Well, we need to know the rules of debit and credit. Debits increase assets. Assets are reduced by credits. Notice that the rules will be opposite on the other side of the equation. Liabilities and equity increase by credits, decrease by debits. So going back to the example that I was referring to a moment ago, if Smart Touch issues $30,000 of stock for cash, what happens? Cash increases, and so does the stockholders' equity. To increase cash, we debit, and that amount was $30,000, cash for $30, and we credit stockholders' equity for $30. So now not only do assets equal liabilities plus equity, but now debits are equal to credits, because you have $30,000 of debits and $30,000 of credits in this company's financial ledger or accounting ledger. Next example, same idea, using Smart Touch again when they purchase land. Again, just as we looked at a few minutes ago, when land is purchased, cash goes down, land goes up. You're talking about assets. So what are the rules of debit and credit? We'll go over this again in a few minutes. But assets increase by debits, decrease by credits. In this case, the asset that's increasing is land. So if land goes up, we have to debit the land. If another asset goes down, which is cash, that has to be reduced by a credit. So once again, assets equal liabilities plus equity, and debits are equal to credits. Because this now, as we said, does not change the equation. The equation still balances because all we did here is change the composition of the assets and not the total. What about stockholders' equity accounts? Stockholders' equity accounts get a little bit tricky. Just take common stock, for example. Common stock is one type of equity account. And equity accounts, as we said, are on the other side of the equation. Equity accounts will increase by credits, decrease by debits. So if you issue common stock, as we just did for Smart Touch, we increased it by a $30,000 credit when we issued capital stock. If for any reason capital stock declines, we're going to wind up debiting that account. Now, what gets tricky are accounts like dividends and expenses. Because anytime, and we'll see this in a few minutes, anytime you debit a dividend, you increase dividends, but at the same time, you are reducing stockholders' equity. Specifically, you're reducing equity through retained earnings. And this is very clear in our next slide, because what I want to do is add dividends. And we're going to debit this to increase it. So when we look at the composition of retained earnings, remember, retained earnings is going to be made up of a beginning balance and then the change. The change in retained earnings is net income or loss minus dividends. Net income is revenues minus expenses. So it is important to note that retained earnings increase by credits, decrease by debits. When I have a revenue increases wealth, increases retained earnings. Therefore, the rules of debit and credit logically will say that we increase revenues by a credit. When I credit a revenue account, I increase retained earnings. Also logically, if expenses reduce my wealth, they will reduce retained earnings, and therefore, in order to reduce retained earnings, I have to debit retained earnings. However, expenses are accumulated by debits. So when I debit an expense, I increase an expense, but I reduce wealth. I reduce retained earnings. The same thing is true with dividends. When dividends go up, I debit that account. Dividends accumulate by debits, but when I debit dividends, I also reduce retained earnings. So as a result, the tricky pieces of the rules of debit and credit come with revenues, expenses, and dividends. In particular, it's going to be the dividends and the expenses because it's counterintuitive. You increase an expense, but you're reducing stockholders' equity through retained earnings at the same time. When you increase dividends, again, it's counterintuitive in that we will have a decrease in retained earnings, but an increase in dividends at the same time. So the following rules of debit and credit are critical. Have to be memorized. So we have the accounts, we have their debit and credit rules, and we have the normal balance. The normal balance is the side of increase, and typically that normal balance holds up. On occasion, you might find something different. You might have an opposite balance, but typically debits and credits and their side of increase is, of course, the normal balance. So let's go through this. Assets increase by debits, decrease by credits. What's the side of increase? Debit side. So its normal balance is debit. Liabilities increase by credits, decrease by debits. The normal balance is the side of increase. It's the credit side. Common stock and retained earnings. These are equity accounts. They increase by credits, decrease by debits. Their normal balances are credit balances. Revenues. Revenues increase retained earnings so that if revenues, and I'll get to the dividends in a second, if revenues increase equity, then they should be increased by a credit, and therefore their normal balance is a credit balance. Dividends. Dividends reduce retained earnings, so that therefore it's going to be just the opposite. In other words, when you increase dividends, you debit them, but that's when you decrease retained earnings. If dividends decrease for whatever reason, they would actually increase your retained earnings. So dividends are increases, are debits. Its normal balance is a debit. Expense is the same thing. It's counterintuitive. When I increase an expense, I reduce equity. So therefore, I debit expenses to increase them. Normal balance of an expense is a debit balance. Two other ways to look at this. What we really need to do is to ensure that we understand that when we use ledger accounts or T accounts, we are in fact still maintaining the equality of the accounting equation. So you notice that assets equal liabilities plus stockholders' equity, but at the same time, debits are equal to credits. So once again, for example, let's take the issuance of capital stock by Smart Touch. When we issued the capital stock, we increased the asset cash by 30. And on the accounting equation, we also increased common stock, there was no change in liabilities, by 30. So the accounting equation balanced. How does this play out now that we have T accounts? Well, common stock goes up, cash goes up. Cash goes up by a $30,000 debit and a credit of $30,000. Therefore, debits are equal to credits and assets equal liabilities plus stockholders' equity. I think the most difficult part of the rules of debit and credit come in when we look at these stockholders' equity relationships. The diagram you're looking at here is one very large stockholders' equity account, which does not exist. This is just a device, hopefully to help you to learn the relationship between revenues, expenses, dividends, and contributed capital on the total stockholders' equity of a company. Now, contributed capital, for us, we've been calling it common or capital stock. So that when you have an increase in common stock, you increase stockholders' equity. When revenues increase, your wealth goes up, again, you increase stockholders' equity. The tricky part, and these are consistent, the tricky part will be the expenses and the dividends. Expenses increase by debits, but when you debit an expense, you're reducing wealth. The debit reduces total equity. Actually, it goes through retained earnings. And when you debit a dividend, the dividend is increased, but we're reducing total stockholders' equity. So once again, that works a little bit counter. So you have to think about the relationships of stockholders' equity just a bit. Let me just go to the whiteboard for a second and just kind of spell this out for you. Let me clear that or erase the whiteboard. So what I'd like you to think about is that if we took retained earnings and made sort of a giant retained earnings account, which does not exist, of course. We know that retained earnings increases by a credit, decreases by a debit, and its normal balance is a credit. What are the components of retained earnings? Components of retained earnings are revenues, expenses, and dividends. We know that retained earnings increases by credits, decreases by debits. What's going to happen again is that, of course, just remember that revenues minus expenses are going to be your net income or loss for the period, or net loss, just to be specific. All right, so let's go through this one more time. Retained earnings. Your wealth increases by revenues. Therefore, revenues increase by a credit, and that will increase retained earnings. Expenses increase by a debit. When you debit retained earnings, you reduce retained earnings. So anytime you debit an expense, you are also reducing wealth by decreasing retained earnings. And dividends, the same thing. Anytime you debit a dividend, you increase. Now remember, you're increasing the dividend account, you're increasing the expense account by a debit. But when you debit a dividend, you're decreasing stockholders' equity. Now, we're also going to move on to the next module, but we're also going to look at something other than these T accounts to record business transactions. So if I erase the whiteboard, and let me just tell you that in the next module, when we record business transactions, now remember, we started with the accounting equation, which is really cumbersome. I mean, just think about a company with hundreds of thousands of sales. I mean, you'd have an accounting equation that would be endless. It would be so large that it would be not very useful for information. And you know that we had business transactions recorded in this module by using the T account, an informal visualization of the general ledger, or just the ledger. We're also going to precede that, as we move to the next module, with recording the transactions in a journal. And as we'll see, the benefit of using the journal is it keeps transactions it maintains an entire transaction, whereas T accounts split that transaction. So if you remember, $30,000 of equity increased by a credit, cash comes in, $30,000 of cash increased by a debit. Well, these could be on separate pages. You remember that cash could be, 101 and common stock could be 301. So these could be on several different, or pages and pages, even on a computer record, they could be separated and you'd have to drill down to find them. So in a journal, we book them in one spot and they are in chronological order. So they are in date order. Makes it easier to find. So we list the transactions in date order. So we'll see that in the next module or in the next learning objective.